Welcome back to the deep dive. I have a spreadsheet open in front of me right now that it just shouldn't exist. It defies the basic laws of gravity for an industrial company.
I think I know which set of numbers you're looking at.
It has to be Lennox International. We're looking at their Q4 2025 performance, which just dropped today, January 28th, 2026. And here's the paradox.
Yeah.
Revenue dropped 11% in the fourth quarter. Volume, the actual number of boxes they sold, plummeted. The industry is in the middle of this chaotic, destocking phase.
Right. By all traditional logic, their profit margins should have been just decimated.
Exactly. But they weren't. Lennox reported record full-year margins of over 20%. They made more money on every dollar of sales than ever before.
Despite selling significantly less stuff, it's a fascinating anomaly.
So that's our mission today. We're doing a forensic analysis of this. We're digging into the Q4 earnings transcripts, the 2026 strategic outlook, and the investor slides to figure out how this HVAC giant is pulling off this insane balancing act.
It's a great case study. We're watching a legacy company execute a very difficult pivot. The CEO, Alok Mascara, he calls it a shift from stabilization to growth acceleration.
But when you actually read between the lines of the transcript, it's really a pivot from relying on their residential business to a much grittier, high-margin commercial strategy.
And they're projecting 6 to 7% growth for 2026, which, after the mess of 2025, that feels ambitious.
Very ambitious. So let's break down the machine. Before we get to what I'm calling the margin plot twist, we should probably clarify what makes Lennox different from, say, a Carrier or a Trane.
Okay, so it starts with the structure. Lennox is basically a two-headed beast. You have Home Comfort Solutions, or HCS.
That's the residential side, the gray box outside your house.
Correct. Your furnaces, your ACs, that's historically been about 2/3 of their revenue.
And the other third?
That's Building Climate Solutions, or BCS. That's the commercial side. Rooftop units for strip malls, schools, that kind of thing, and refrigeration systems.
But the real secret sauce isn't what they make. It's how they sell it. This direct-to-dealer model.
This is their moat. Almost everyone else in the industry sells through a wholesale distributor. Carrier sells to a middleman who marks it up and then sells it to the local contractor.
Lennox just skips that whole step.
They skip it entirely. They sell directly to the person in the van.
I've always thought that sounds great for margins. You capture the manufacturing profit and the distribution profit, but isn't it incredibly risky?
How so?
Well, if you skip the distributor, you're the one holding all the inventory. You take the credit risk. If the market freezes, you don't have that buffer.
That is the trade-off. It's definitely capital intensive, but what they get in return is data. Pure data fidelity. They know exactly what's being installed in real time.
They aren't waiting for a monthly report from some third party.
Exactly. And financially, that extra margin they capture seems to outweigh the risk so far.
Okay, so that's the baseline. High control, high margin, high risk. Now let's get to this Q4 anomaly, the margin inversion.
It really was the headline of the quarter. For decades, residential has been the cash cow. But in Q4 2025, the script just completely flipped.
Residential margins dropped to, what, 17.7%?
Yep, because of that volume decline. But the commercial side, margins surged to 23.1%.
That is a massive spread. The quote-unquote boring commercial business is suddenly way more profitable than their flagship residential side. How did they squeeze that much profit out when the whole market is down?
It wasn't an accident. It was a very specific operational bet they made, centered on a strategy they call emergency replacement.
I saw that phrase in the transcript, emergency replacement. It sounds like something you do in a hospital.
The urgency is surprisingly similar. Look, imagine you run a busy restaurant, or maybe a server room. It's August. Your rooftop AC unit dies.
You're in big trouble.
You're losing money every single hour. You cannot wait 3 weeks for a custom order. You need a box, and you need it today.
You don't care of the brand. You care about who has it on a truck, ready to go.
Precisely.
Yeah.
Lennox realized that availability is a quality all its own. They saw the industry lead times were lagging, so they used their facility in Saltillo, Mexico to just ramp up capacity.
So they purposely built inventory without having orders in hand. That's that risk we talked about.
It is a calculated risk. They built the most popular models, the ones that fit 80% of rooftops, and just staged them to ship immediately.
And it paid off.
Big time. They grew commercial revenue by 8% in Q4. And you have to remember, the broader light commercial market had been down for 17 consecutive months.
The 17 months, so everyone else is shrinking, and Lennox is growing by stealing their lunch.
Because when the phone rings for an emergency, they're the only ones who can say, yes, we can ship it tomorrow.
That's a pure operational win. But the CEO, Mascara, he isn't satisfied. He laid out this whole growth algorithm for 2026. And I have to say, the first pillar of this plan seems incredibly mundane.
You're talking about the parts strategy.
Yes, a company that engineers these complex thermodynamic systems. And their big growth bet is selling capacitors, screws, and duct tape. They spent $500 million on NSI's HVAC division.
$550 million for brands like Durodyne and Subco. For the small stuff.
Why?
It's a share of wallet play. Think about the psychology of a sales rep. For years, Lennox reps were big game hunters. They wanted to sell the $10,000 system.
Right. They didn't care about the $20 capacitor. The commission is nothing.
But the contractor needs that capacitor. And if they have to drive to a different supply house to get it, Lennox loses that connection, that touch point.
So they're trying to capture the entire bill of materials for a job. What's the potential upside?
Well, right now, their attachment rate, that's selling parts alongside the big equipment, it's only about 15%.
Okay.
They want to double that to 30%.
But the logistics of that, I mean, it's one thing to buy the company, it's another to integrate it. You're talking about thousands of tiny little parts that have to be stocked everywhere. Sounds like a supply chain nightmare.
It's a heavy lift, no question. They have to revamp their stores. They're calling it a fanatical culture shift. The logic is if you save the contractor one trip to a second store, you own their loyalty. But you're right, the execution risk is real.
Okay, so that's one pillar. The other big one is expanding their market through joint ventures. They announced a big partnership with Samsung.
Right. And the CEO had that funny line about it.
The joke about sealing the deal by going to Korea and drinking a lot of soju.
Laughs, yeah. But behind that joke is a very serious business case. Lennox had a huge, glaring hole in its product line. Ductless mini splits and VRF technology.
Variable refrigerant flow. That's the stuff that's all over Asia and Europe.
And it's finally taking off here. Lennox had less than 2% market share in that category. The industry penetration is over 10%. They were a non-player.
So instead of spending a decade and $1 billion trying to invent their own,
they just partnered with Samsung. They'll sell Lennox powered by Samsung units. It's an immediate catch-up. They get access to world-class tech without the R&D burn. It expands their total addressable market overnight.
Smart. Okay, we've covered the nuts and bolts. We have to talk about the elephant in the room.
Yeah.
AI. Every earnings call I listen to in 2026 mentions AI.
It's unavoidable.
Is this just buzzword bingo to pump the stock, or is there actually something real here?
I share that skepticism, but here, the application is surprisingly operational. They're using AI to solve that inventory problem we keep talking about.
How?
Think about the data they have from their direct-to-dealer model and from warranty registrations. They have a massive data set of when units were installed and when they break.
Right.
They're feeding 10 years of that data into AI models to predict destocking trends.
So they're trying to build a minority report for HVAC failure to predict demand before the contractor even knows they have a job.
That's the ambition. If you can accurately predict when a bunch of furnaces from 2012 are going to fail in the Northeast, you can position your inventory perfectly. It's a huge efficiency edge.
That actually makes sense. And they're also trying to get into the data center boom. But let's be real, they aren't competing with Vertiv on a massive Google data center.
No, and they're very clear about that. They're targeting the edge and light commercial data centers, smaller server rooms. They can use their existing commercial refrigeration tech for that. It's a smart way to get exposure without betting the farm.
Okay, we've been pretty positive. We need to look at the bear case. Management explicitly warned that Q1 2026, the quarter we are in now, is going to be rough. They use the term air pocket.
Which is a polite way of saying our margins are about to take a hit. And it's a self-inflicted wound, really. In late 2025, they intentionally built up about $200 million in excess inventory.
To keep the factories running smoothly, the level loading thing.
Exactly. It's expensive to shut a factory down and start it up, so they kept making stuff. Now they have too much stuff. So in Q1, they have to slow the factories way down to burn it off.
And that leads to factory under-absorption. Can we unpack that term?
Sure. Imagine you own a restaurant kitchen. You pay rent and electricity, whether you cook 1 burger or 1,000. Those are fixed costs. If you only cook 10 burgers, the cost per burger skyrockets because each one has to absorb all that rent.
So by slowing the factory, their cost per unit goes up and their profit margin shrinks.
Exactly. It's going to hit their margins by about $10 million in Q1. It's temporary, but the start of the year will look ugly.
And the other big risk is the consumer. this repair versus replace trap.
This is where macroeconomics hits the kitchen table. Interest rates were high. A new HVAC system is expensive, maybe $12,000, $15,000.
So when your AC broke last summer, you didn't buy a new one. You paid $500 to patch the old one.
Repairs skyrocketed, replacements fell. The risk for Lennox is, what if that's the new normal? What if consumers just decide to keep their units for 18 or 20 years instead of 15?
But management has their counterargument: deferred replacement.
The coiled spring theory, their view is you can only patch a machine so many times. Physics eventually wins. That compressor will die for good. They believe all those people who didn't buy in 2025 are still out there, just pushed into 2026 or 2027.
So they're betting on a huge wave of pent-up demand.
That's the thesis. And if interest rates come down even a little bit, that spring could uncoil very, very fast.
Let's wrap up with financial health. Despite the Q1 air pocket, the full-year outlook seems pretty strong.
It is. They're guiding for 6 to 7% revenue growth. But the real story that investors care about is cash. Lennox is a cash machine. They generated $640 million in free cash flow in 2025.
And for 2026?
They're expecting between $750 and $850 million. That's a massive amount of liquidity.
And they're doubling their capex to $250 million. That's a confident move.
It signals they aren't in bunker mode. They're investing in R&D labs, new training centers, the IT for those AI projects. They're spending money to widen that moat.
So bottom line, Lennox in 2026, what's the verdict?
I'd call it a quality compounder. They are exiting a cyclical trough. They've proven they can expand margins when sales are down, and now they have these growth levers parts, Samsung kicking in.
It's a show-me story that's actually starting to show us something. The post-Q1 weakness might be the entry point people are looking for.
I think so.
So here's the thought I want to leave everyone with today. We talked about that repair versus replace dynamic. Management is all in on the coiled spring theory.
That deferred sales are coming back.
But I wonder if we're seeing a structural shift, kind of like what we see in the auto industry, where the average age of a car is at an all-time high. People just holding on to things longer.
That is a very valid fear.
If the 15-year lifespan of an AC unit permanently becomes an 18-year lifespan, that coiled spring doesn't snap back, it just stretches out. And if that happens, that 6% growth target for 2026 is going to be incredibly hard to hit.
If the replacement cycle has structurally lengthened, the entire industry valuation needs a rethink. That's the multi-billion-dollar question.
Something to think about the next time you hear your furnace make a weird noise. Is it a replacement opportunity or just another $200 repair? That's it for this deep dive. Thanks for listening.
See you next time.